Despite a volatile interest rate landscape in 2024, Matco's Diversified Income Fund delivered a 3.7% return. The healthy income of 4% offered by the fund was modestly offset by higher interest rates, despite central banks lowering their overnight rates at the front end of the yield curve. Now, as we turn the page on a challenging yet transformative year in global markets, let's explore the trends and risks and opportunities ahead for Canadian bonds, income investments, and interest rate strategies in 2025. Key considerations include global central bank monetary policy and the expectations around interest rates, Canadian credit market and the outlook for corporate bonds, a pending Canadian election, and certainly the prospects of a potential global trade war. Now, with respect to central bank policy, Bank of Canada led the way in rate cutting in 2024, reducing their overnight interest rate from 5% down to the current 3.25 through multiple interest rate cuts. Now, for 2025, we do anticipate further reductions to the tune of 0.75%, bringing that rate down to 2.5. These cuts could ease mortgage rates for the 1.2 million mortgages being renewed in 2025, but they may also pressure the Canadian dollar. Within Matco's portfolio, we have locked in higher interest rates by investing in fixed-rate medium and long-term bonds, while replacing older, lower-yielding bonds with newer, higher-coupon ones. Now, shifting globally, the U.S. Federal Reserve is expected to cut rates by 50 basis points, though some analysts predict a pause in the labor market and inflation remain resilient. In Europe, the ECB's rate projected to drop from 3 to 1.75, while the Bank of England is expected to lower rates modestly by 1%. Globally, keep in mind 70% of central banks are in easing mode due to slower growth and moderating inflation. Now, shifting gears again to the credit markets, in a complex environment with potential U.S. tariffs looming, a cautious approach favoring higher quality investment-grade corporate bonds is certainly prudent. Credit spreads remain a little bit tight, supporting selective exposure to issuers with strong balance sheets and minimal reliance on exports. On the horizon, one can't ignore both the pending Canadian election and the global trade risks. Though the timing of the next election is uncertain, polls suggest a potential Conservative majority, which could unlock growth opportunities and stabilize interest rates by late 2025 or 2026. Meanwhile, the prospects of a U.S.-led global trade war pose headwinds for Canada, likely keeping the Bank of Canada in easing mode. Within Matco's diversified income portfolio, our duration approach is focused on medium-term bonds, which are positioned to benefit from further rate cuts, while the long end of the yield curve will be monitored for inflationary pressures from tariffs. Now, in terms of credit, the focus remains on high-quality corporate bonds with a slightly reduced allocation. We are avoiding highly leveraged companies and vulnerable sectors. Our active management emphasizes financial health and resilience. Now, lastly, from a provincial bond perspective, we do favor a modest allocation which adds incremental yield over and above just pure federal bonds. Now, the income market in 2025 presents a balanced outlook. Rate cuts and easing financial conditions support bond prices and yields, but risks such as an economic slowdown, trade uncertainty, and election developments remain always a constant uncertainty. Matco's Diversified Income Fund is well positioned with a strategy focusing on duration, credit quality, and yield curve management to navigate this evolving landscape.